Welcome to the deep dive. We're here to, cut through the noise of corporate reports and give you the real strategic story. Today, we're digging into Wipro Ltd. Specifically, their audited results for the quarter and half year ending September 30th, 2025. That's Q2 of their fiscal 26.
That's right. And these results, just approved by the board, they paint a really interesting picture. It's almost like two different stories happening at once. On one hand, you've got this incredible momentum in booking future business, like record levels. But on the other, there's the immediate reality of a pretty tough economic climate impacting current results.
Exactly. So our mission today is to kind of unpack that tension. Where is Wipro really heading, especially with all this talk about big deals and AI?
Well, let's try and synthesize it.
Okay, so let's start with the basics, the top line, the IT services segment revenue number.
Right. The headline figure came in at $2,604.3 million for the quarter.
2.6 billion. Okay. And the crucial bit, how did that compare to the last quarter, the sequential growth?
Well, sequentially, it was up, but just barely. 0.3% growth in constant currency terms.
0.3%. So positive, but flat is probably a fair description.
It is. And for those of you tracking, constant currency is key here, right?
Yeah.
It takes out the currency fluctuations, gives you that cleaner operational view. So yeah, 0.2% shows they're inching forward, but it's definitely not, the rapid acceleration you might hope for.
And that's the paradox right there, isn't it? This tiny growth number sitting next to what you hinted at, this explosion in their pipeline. It really forces you to look under the hood, past that top line figure. Okay, so let's unpack the profitability side then. Margins. That always tells a story. The reported IT services operating margin was 16.7%.
It was. But, and there's a big but, that 16.7% needs some serious context. You can't just take it at face value.
Why's that? What happened?
Well, they had to absorb a pretty significant one-off hit this quarter, a provision of, $1,165 million.
Okay, what's that in dollars?
That translates to about $13.1 million. And it was entirely related to one specific customer filing for bankruptcy.
Oof, that's gotta hurt. And definitely raises questions about client risk in this environment.
It does. It's a tough charge. But the important thing is, it is a one-off. So if you adjust for that.
Right, let's adjust for it. What does the cleaner sort of underlying operational margin look like?
Once you pull out that bankruptcy provision, the adjusted IT services operating margin actually comes in at 17.2%.
Okay, 17.2%, that sounds better. How does that compare year on year?
That's the key point. That 17.2% is actually up. It represents a 0.4% expansion compared to the same quarter last year. So despite investing heavily and despite taking that hit, their underlying profitability actually improved year on year. Shows some discipline.
That discipline seems reflected in their cash management too, right? Net income was $32.5 billion, or about $365 million, up just 1.2% year on year. Pretty modest.
True, the net income growth itself is modest. But look at the operating cash flow. It came in at $33.9 billion, or $381.5 million.
Okay, and how does that relate to the net income?
That cash flow is 103.8% of the net income for the quarter.
Wow, over 100% conversion. That's strong.
It really is. It shows they're managing working capital very tightly, turning those profits sufficiently into actual cash they can use. Very disciplined.
And speaking of discipline and stability, what about their people? Attrition has been a big theme across the whole sector.
Yeah, and Wipro's showing some positive signs there too. Voluntary attrition, looking to the trailing 12 months, dropped quite a bit. It's down to 14.9%.
14.9, that's a noticeable improvement.
It is. Lower attrition means lower costs for hiring and training, which, helps support those margins we just talked about. In this kind of tech talent market, keeping your experienced people is absolutely critical.
Okay, so margins improving underneath, cash flow strong, attrition down. But now we have to get back to that paradox, the deal momentum. This is where the story gets, maybe a bit more exciting. The pipeline they built this quarter seems huge compared to that 0.3% growth.
This is absolutely the core of their forward-looking story, I think. Total bookings for Q2 hit $4.7 billion, which is, a very solid number.
4.7 billion total, okay.
But the real headline grabber is the large deal bookings. These are the big ones. Deals worth $30 million or more in TCV.
TCV. Let's just quickly clarify that for listeners.
Right, good point. TCV is total contract value. It's the potential lifetime value of the contract. Not revenue recognized today, but the future business locked in.
Got it. So how much was that large deal TCV?
It hit $2.9 billion. Or $2,853 million to be precise.
2.9 billion in just large deals in one quarter. How does that compare? What's the growth rate there?
Compared to last year, It's staggering. Large deal bookings increased 90.5% year-on-year in constant currency.
Whoa, 90.5%. That's massive.
It really is. And if you look at the first half of their fiscal year, H1 FY26, total bookings are already over $9.5 billion. It signals they're winning really significant work, often tied to clients consolidating their vendors or pushing major digital and, importantly, AI transformations.
Okay, so they're winning the business. What kind of business are these huge deals? You mentioned consolidation and AI.
Exactly. You see two main themes. First, there's the classic consolidation and modernization play. Like they want a big multi-year deal with a major European financial institution. That one's focused on infrastructure modernization, the cloud migration, consolidating compute, network, storage, basically helping the client save money and become more agile.
Standard, but important stuff. And the second theme, the AI-driven deals.
Yes, and these are maybe more strategic looking forward. They secured a significant AI-led engagement with a top UK financial services group. And they're not just, talking AI. They're deploying something called a modular agentic AI framework.
Agentic AI. What does that mean in plain English?
Think of AI systems that can act more autonomously. They can plan and execute complex tasks, not just respond like a chatbot. In this case, it's to analyze payments data in real time. Huge implications for strategy, compliance, everything.
So AI moving from lab experiments to core operations. That's a big step.
Definitely. Another example, a U.S. tech giant chose Wipro to speed up their cloud networking and storage infrastructure build-out. And crucially, they're integrating AI-powered tools into that process itself to make it faster. Core transformation stuff.
And to kind of harness all this AI momentum, Wipro also rolled out a new platform, right, to standardize their offerings.
Yeah, they launched Wipro Intelligence. It's positioned as their unified suite of AI platforms. The idea seems to be creating repeatable, scalable AI solutions rather than just building custom one-offs every time.
Makes sense. Build the IP, are they tailoring it?
They are. They highlighted specific industry solutions built on it. Things like Auto Cortex for automotive, Wealth AI for banking and finance, and Pay AI for healthcare, embedding AI into those core industry workflows.
Okay. And before we get to the segment details, there was also that acquisition announced back in August, Harman's DTS unit.
Right, shouldn't forget that. August 21st, they agreed to buy the Digital Transformation Solutions, or DTS, business from Harman, which is owned by Samsung. It's a $375 million deal expected to close this current quarter, Q3. The goal there is clearly to beef up their digital engineering muscle.
All right, so we have this picture. Adjusted margins up, cash flow great, attrition down, massive deal wins, new AI platform, and acquisition. Which brings us back again to the paradox. Why only 0.3% sequential growth? Where's the weakness offsetting those strengths? Let's break down the segments.
Yeah, the headline number definitely hides some big swings underneath. Geographically, Europe was actually a bright spot. It returned to sequential growth after quite a few tough quarters.
Oh, really? How much growth?
Up 2.7% quarter-on-quarter in constant currency. And at EMEA, Asia-Pacific, Middle East, Africa also did well, up 3.1% sequentially.
That Europe growth is interesting. Maybe some of those earlier acquisitions like Capco are starting to really integrate and deliver now.
Could be. It suggests that strategy of investing outside the U.S., focusing on specific capabilities like finance consulting, might be paying off. That 2.7% is definitely a positive signal.
Okay, but if Europe and APMEA are growing, the drag must be coming from the Americas, their biggest market.
Unfortunately, yes. Americas 2 specifically saw a sequential decline of 2.0% in constant currency. That market seems particularly sensitive to, interest rate worries and companies pulling back on spending.
And sector-wise, where did the growth come from and where was the pressure?
Sectorally, the growth drivers sequentially were BFSI banking, financial services, insurance up 2.2%, and also technology and communications up 0.8%. Again, probably linked to those big consolidation deals.
So BFSI and tech holding up. Where's the real pain point then?
It's concentrated in a couple of areas, still feeling macroeconomic pressure. The consumer sector was down 1.7% sequentially, and EMR energy, manufacturing, and resources, that was down 1.5%. Wipro explicitly mentioned these are still getting hit by things like tariff uncertainty, supply chain issues, causing clients to pause some IT projects.
So a very uneven picture. Growth in some areas, decline in others. What does this mean for the immediate future? What's the guidance for next quarter, Q3?
Okay, for Q3, the quarter ending December 31st, 2025, they're projecting IT services revenue between $2,591 million and $2,644 million.
Right. And what does that translate to in terms of sequential growth, like the 0.3% we saw this quarter?
In constant currency, That guidance translates to a range of minus 0.5% to plus
Yeah,
1.5%.
minus 0.5 to plus 1.5. That is a
Right.
very cautious range, isn't it? Especially after booking $2.9 billion in large deals. It suggests converting those massive wins into actual billable revenue is going to take time, maybe phased heavily into later quarters.
That seems to be the challenge, yes. These large transformation deals, even the AI ones, often have a ramp-up period. You're replacing old systems, integrating things. It doesn't happen overnight. And there's a crucial footnote to that guidance, too. It doesn't include any expected revenue from that Harman DTS acquisition yet.
Ah, okay. So that $375 million deal isn't baked into those Q3 numbers at all. That adds potential upside later, but uncertainty for now.
Exactly. It will only kick in after the deal closes.
So if we zoom out, the big picture seems to be Wipro is playing the long game, leveraging market consolidation, winning huge deals, pushing AI hard. But in the short term, they're still navigating choppy waters in certain sectors, which is keeping that overall growth number pretty muted for now.
That sums it up well, I think. The theme is definitely about converting that massive deal pipeline, remember the 90.5% jump in large deals, into sustained revenue growth, all while trying to hold on to that improved 17.2% adjusted margin and waiting for sectors like consumer and EMR to maybe stabilize.
The pipeline is definitely there. The conversion speed seems to be the key variable now. So for you, the listener, the key takeaway is probably this. The forward investment is undeniable. Wipro Intelligence, those huge deal wins, it signals a real concrete bet on an AI-first future and capturing market share during this consolidation phase.
Which leaves us with a really interesting question to ponder, doesn't it? We saw Europe and BFSI returning to sequential growth, which is great, but we also heard many of those Q2 mega deals were renewals, basically replacing existing contracts, maybe adding modernization. The big question is, how quickly can Wipro turn these renewals, these foundational deals, into genuine new expansion revenue? Can they effectively upsell? Can they make those AI projects grow significantly within existing clients? That ability to expand within the base beyond just renewals is likely what's needed to push their guidance beyond this current kind of narrow band in the coming quarters. Something to watch closely.